After yet another brutal jobs report exposing just how shaky the 2025 economy really is, the stock market shrugged it off as if nothing happened. People are numb to the word recession. Every single year since 2020, someone has been calling for one, and this channel has been guilty as well. In 2021, it was supply bottlenecks, labor shortages, and the implosion of Chinese real estate. In 2022, the energy shock and Russia's war in Ukraine. In 2023, the Fed's relentless rate hikes and a deeply inverted yield curve. In 2024, it was commercial real estate, corporate debt, and higher for longer. And now, in 2025, the spotlight has shifted. The labor market, the one pillar everyone trusted to hold up the economy, is finally starting to crack. It might sound like the same tired warning, but this time is different. If there's ever been a moment to stop brushing off the risks, it's today, because when jobs weaken, that's not just noise, it's the exact recipe for a financial disaster. And this is where it gets even more dangerous. The labor market doesn't just weaken in plain sight, it hides behind numbers that are confusing at best and misleading at worst. And this isn't exaggeration. The truth is, unemployment in America is actually very difficult to measure. You got all these different reports, ADP, BLS, the U-rate, payrolls, participation, and each one tells a slightly different story. On top of that, most of the data comes from surveys, adjustments, and complicated statistical models that are delayed and hard to interpret. It's no wonder the average person feels like the numbers are designed to confuse. So the better way to think about the labor market is this: don't rely on one single number. Instead, treat each report like a light shining from a different angle. On its own, it might not tell the whole story, but together they start to paint a trend. And right now, all of those lights are flashing red. Let's start with the unemployment rate, 4.3%. On paper, that doesn't sound terrible, especially compared to the chaos of 2020, but context matters. Since the lows of 2022, unemployment has been creeping higher month after month. We're not officially in recession trigger territory yet, but the trajectory is undeniable. The job market is softening and the danger is building. Now look at the ADP report. This is private data pulled from real-time payrolls across millions of workers, so it often catches turning points faster than the government surveys. And the signal is ugly. Private sector job creation has collapsed in recent months. Small businesses, the backbone of the labor market, are getting hit the hardest. Fewer employees, weaker hiring, less cushion. This is not the picture of a healthy economy. Then there is the BLS job report, which is supposed to be the gold standard, but it's under fire. After a string of weak reports and repeated downward revisions, President Trump actually fired the head of the Bureau of Labor Statistics. That kind of political interference raises its own questions, but the data itself is concerning enough. Net job growth over the last 3 months has collapsed to essentially zero. Take a look at this chart. It shows the cliff-like drop in jobs added, and it's another piece of hard evidence that something is deeply wrong in the labor market. When you line it all up, rising unemployment, collapsing ADP numbers, downward BLS revisions, it's not noise anymore. These are converging signals pointing in the same direction, and that direction is down. On Tuesday, we saw the biggest BLS revision in 25 years, wiping away nearly 1 million jobs off the books. That's not background noise, that's a red flag shaking confidence across Wall Street. Even Jamie Dimon, head of the world's largest bank, JP Chase, didn't sugarcoat it. He flat out admitted the economy is weakening and the jobs data is deeply troubling. Here's a clip from a recent interview recorded just as the numbers dropped. It speaks volumes about how serious this moment really is.
We're going to keep on building.
And this is a celebration of workers, of the labor force. We learned today that the number of workers on payrolls will likely be revised down by 911,000 for the 12 months through March. Does this amplify any worries you might have about potential weakness in the labor market?
I didn't know about the number. You know, I think the economy's weakening. You know, whether that is on the way to recession or just weakening, I don't know, and that just confirms what we already thought, kind of.
And I know
that's a big revision. So
those are big revisions. Yeah. I believe it's the biggest going back to 2000. And the day after you and I sat down in North Carolina about a month ago was the day that President Trump fired the commissioner of the Bureau of Labor Statistics. And since then, there have been some questions around, politicization of the data. And since you operate such a sprawling bank and you have unique insights, do you see any gaps between the numbers that the government's putting out and what you see within your own firm? And are you increasingly relying more on the numbers that you see within your own firm?
No, we get data like you wouldn't believe. The government data is important, our own data is important. We get data from non-government sources, and you can look at delinquency data, worldwide data, trade data. We get all of that, but trying to figure out what the economy is going to do is still hard to do with all that data. And maybe one day AI will fix that problem, but hopefully things will be okay. But you do see that kind of weakening, unfortunately.
So with this, that begs the question of rates. We all know interest rates have been on a relentless climb since 2022, reaching as high as 5.3%. For nearly 2 years, higher borrowing costs have been the medicine the Fed prescribed to cool inflation. But now, with the labor market flashing red and revisions erasing nearly 1 million jobs from the books, that narrative is breaking down. The consensus on Wall Street is suddenly obvious. Rate cuts are coming, and they're coming fast. Now here's where it gets interesting. In the short term, the market is celebrating. Stocks are bubbling higher, housing bulls are breathing a sigh of relief, and traders are piling into risky assets. It's this same strange paradox we've seen again and again, where bad news is good news. Weak jobs, soft growth, and cooling inflation, that's the perfect excuse for lower rates. But zoom out, and that excitement looks more like dancing on the edge of a cliff. History is very clear on this point. Rate cuts don't come when things are fine, they come when things are already breaking. Since at least 1990, every major rate cutting cycle has been less of a rescue and more of an obituary. In 1990, cuts marked the start of a recession. In the early 2000s, cuts began after the dot-com bubble burst, too late to save it. The Great Recession, same story. Rates came down only after the housing market had already imploded. Even in 2019, when the Fed tried mid-cycle adjustments, it didn't stop the economy from plunging into chaos with the pandemic. The pattern is hard to ignore. Rate cuts usually signal the beginning of the downturn, not the end of one. That's why the idea that slashing rates in 2025 will somehow prevent a recession feels like wishful thinking. If anything, it confirms the recession is already here, and that's why the market's euphoria right now could very well be the classic calm before the storm. And since housing is always the center of these cycles, let me share a resource that's especially relevant if you're serious about real estate. It's called PropStream, an all-in-one platform with data on more than 160 million properties nationwide. You can pull comps, see tax records, liens, and pre-foreclosures, and even build motivated seller lists with over 165 filters. Their lead automator keeps your lists fresh automatically, and their mobile app lets you scout and market properties while you're out in the field. You can try it free for 7 days with 50 leads included using my link below. If you're an investor or you're just trying to watch this market closely, PropStream gives you the edge to spot opportunities before everyone else. That's it for today's breakdown. If you found this helpful, hit that like and subscribe button and let me know in the comments what you're seeing in your local market. Thanks for watching, and I'll see you in the next one.